I think it's so true, just stop doing too much, simplify your strategy, simplify your plan, and really become a specialist or an expert in one area, and then the rest will come. Welcome back to another episode of the Pumped On Property Show. It's good to be here.
Yeah.
Yeah, boy. Today we're going to be talking about the global real estate cycle. This was something that Ben stumbled across about 4 or 5 years ago now.
Yeah, I was deep down a wormhole one night, freaking myself out about the world ending, and thank God fell into like the Phil Anderson, Fred Harrison, Ray Dalio stuff, and changed my life so much for the better.
For sure. So that was back during the Royal Banking Commission, right? And where things were getting a little bit...
Even earlier, man.
Even before that.
Yeah, well before that. Like it was honestly 2016-ish. Yeah, it was a long time ago now.
So what was the reason for falling down that rabbit hole? What brought on the freak out?
I don't know. Honestly don't know. Looking back.
It's so crazy. Like Ben and I are true believers in like everything happens for a reason and the power of the universe and things like that. And it's like unbelievable. Like you can't remember now why it happened, but it is literally the way that we live now.
Yeah.
Like, this cycle has determined the rest of our life.
Completely. Like I remember it. I was like, Lisa was out for the night. I was looking after the kids at home alone, and I'm like, oh, just jump online and read some stuff. I'm like, it's been a couple of weeks since I'd read some stuff. And I'm like, wormhole. Next thing, it's 3 o'clock in the morning. And I'm like, fuck, I've got to get up with the kids in 2 hours. And I think I was like living with a lot of anxiety at that time. I'd been buying a lot of properties. I'd started this business. I'd started another business at the time. I'd gone from like working with myself and my sister to having like 10 or 14 employees across both businesses. Like I was just having young kids, sleepless nights, like still drinking a little bit once a month or so.
Yeah.
And I just felt like...
And you were young, you're only 30 or younger.
31 or something, 32, 31 probably.
Yeah, so a lot of responsibility. So it might have been coming from a place of like, fuck, am I doing the right thing here?
That's exactly where it was coming from. I think I had like 8 or 9 properties that I owned at that time. And I was like, I'm really leveraged and I'm trading 100 hours a week still at that time away from my kids every week. And I'm like, there's got to be like a method to this madness. Like surely somebody has to have looked enough at history to go, there's a pattern. And I just sort of thought buying properties was one thing and, owning a few of them was a good thing, but there had to be more to it. Like there had to be a strategy for actually getting financially free faster. Yeah,
and then when you peek through the rabbit hole of cycles and trends and things like that, you realize a whole nother world, don't you? So there's so many different cycles. People talk about real estate cycles, Bitcoin cycles, stock share trading cycles. So, it's something that's quite common, but, what you've essentially stumbled across is Phil Anderson's book, The Secret Life of Real Estate and Banking, where he talks about an 18.6 year real estate cycle.
Yeah, like it's based on 250 years of his research into the American market, which he had actually stumbled upon someone else's book, which was Fred Harrison's, which looked at 350 years of UK booms and busts. And he just wanted to see if the same thing was true for America that had been happening in Europe for a long time. And he found out it was like really closely aligned. And the cool thing about history is like, we don't always have to like predict the future. We don't always have to like figure it out again. Like a lot of things have happened and you can learn from those things.
Yeah, this information has been documented for clearly hundreds of years now. So it's a lot to go back on and a lot to go and research to figure out, does this plus this mean this? And that's essentially what they're trying to figure out. And Ray Dalio, arguably the most successful investor of all time, talks about these cycles as well. When I went to see Robert Kiyosaki, one of the greatest property investors of all time, he was talking about these cycles as well. And it's interesting, obviously Phil Anderson talks about one particular cycle. Fred talks about a similar one. Ray and Kiyosaki are sort of talking about different but similar sorts of ideas as well.
Whoever's concept you follow, it's good to know that there are different ideas
Yeah.
out there. You know what I mean? Whether you think it's a 7-year thing, a 10-year thing, an 18 or a 20-year thing, what's important to understand is that money and sentiment flow in waves, and money can sometimes be really, really, really cheap and easy to get, like it is now. And that creates a down the line effect. And sometimes money is really, really, really freaking hard to get, and that creates an effect as well. So it's like, it's really a cycle based on the flow of money around the world and how that gets itself into certain hands at certain times, as well as how people are feeling. Like right now, there is a insanely positive perspective that things are going to be good.
Yeah.
And they call it the wealth effect. And it's like when people are making money, people start spending money and people start feeling better. When people are losing money, when things are going down, you get a sort of negative effect. And so you look at 2020 as a very negative year globally. And the effect of that was like almost every single asset class in the world went backwards. You look at 2021 and everything's going off its head, and it's because there's a very, very positive sentiment effect right now.
For sure. And, you know, I've always sort of said, you know, if you want to make people forget about bad times, make them money. People love making money. People love being happy. People
Make
love
me money,
spending
man.
money. Yeah, where's my money, man? Show me the money. Anyway, so what is the cycle? Let's, you know, high level understanding. What is this 18.6 year real estate cycle?
Sure. So, you know, Phil's work's amazing. I highly recommend going out there and checking it out. YouTube, subscribing to his blog or whatever, his newsletter. So effectively the way that him and Fred describe it is we come off an event, let's call it the Great Depression or the GFC, and generally we have a really positive run after that. Now, that looks like to be about 7 to 8 years up of positive run. And if you look at the run that we had between, 2010 to 11.
I think the start of the cycle was 2012.
So let's call it 2012 was the start of the new cycle because everything had been washed away by then from the GFC. So 2012, and we got 7 to 8 years up from there till 2020. And then what we get is stock markets around the world going up, real estate prices, particularly in the big capital cities, going up. So your Londons, your New Yorks, your LAs, your Singapores, your Beijing's, your Sydney's, your Melbourne's crank. And then what happens is stock markets have gone up for a while. The economy's sort of back on track after a really, really devastating event. And they start tightening the money around the world. And they go, shit, it's getting hot. People have made 100% in the American stock market during that time. They made 100% in New York, London, Sydney, and Melbourne. The governments go, shit, like this is, if we keep this going, we're going to have a massive down the line issue. Let's tighten everything up. And that tightening creates what they call like a pause or a mid-cycle slowdown. So what are some like previous mid-cycle slowdown type events?
So we've just been through one, the pandemic during 2020, which initially to us freaked us the hell out.
Yeah,
like,
it scared the shit out of me at the start. And I knew all this stuff.
In March and April, we were trying to scrape together all of the different pieces of information that we could find to try and go, is this a mid-cycle slowdown or is this the end of the cycle?
Is this Armageddon?
Yeah, and you know, that's what happens during a mid-cycle slowdown. A similar time, and the previous mid-cycle slowdown was in 2001 when we had the dot-com bust plus 9/11. You know, there was a lot of negative sentiment around the world. A lot of change came into place at that point in time, and a lot of change is coming into place during the current mid-cycle recession as well. And then, you know, generally this mid-cycle recession can last anywhere from sort of 12 months up to 3 years, according to Phil and his work. And then we essentially come into the second half of the cycle.
Yeah, so, you know, as Simon and I said, when we spent a lot of time in March and April, what we both did was mainly look at Fred Harrison's work. And so Fred found that was like the 13th mid-cycle slowdown on record. And, you know, these are events that hurt. You know, normally property prices either go flat or they go down 10% during that time. What we noticed is that in the last 3 or 4, the stock market had dropped by at least 35 to 45% during that time. But as Simon said, like it normally recovers within 9 months to sort of 2 to 3 years. So we, by the end of April, I think completely had our head around it.
Yeah.
And then it wasn't long after that, I think it was in May or June, Ray Dalio came out and he said, there is an unprecedented amount of bailout going on globally. I think it was just after the announcement from the OPEC countries that they were going to do whatever by any means necessary to bail the world out. And they'd committed at that point to $2 trillion. I think it's up to $8 trillion bailout now.
Massive. And what Phil Anderson was saying in 2019 is that in this mid-cycle recession, there will be massive government spending. There will be massive government bailout. I think in the early days of the pandemic in February or March, Ray Dalio was coming out and saying that he thinks that the economy is going to drop by 30% or something crazy. And then he came back out saying that he had to readjust it because he had no idea how much money these governments were going to be spending. And this is your job seekers, your job keepers, the banks putting your mortgages on holidays, things like that, just to put a cushion underneath the economy and essentially just slap a Band-Aid over the top of it.
So that happens at this stage in the cycle. And then what happens after that is generally like another run. So the stock markets generally perform really good. Assets around the world perform well. The second tier cities and the regional markets and some of the metro markets do very well. We get incredible price growth, and that can last for 4 to another 5 or 6 years. And then we get to a point. So what we've gone through is like a bad time, 7 or 8 years up, a pause point, and then we go through another really good time. Now, as bad as 2020 was from a health perspective and an economic perspective for a lot of people around the world, it's not as intense as like a GFC or a Great Depression that lasted like 2 to 4 years. And so by the time we get to the next top, they're like, oh, that mid-cycle slowdown was pretty bad. Like 2020 was shit. A lot of people lost 40% in the stock market, but they'd made it up within 9 months. A bunch of people lost 10% on their properties or 15%, but they made it up within 2 years. And what we get is like this crazy second half where money's cheap, and we'll talk about this more, where the governments are spending a shitload of money on infrastructure, where business confidence is high, and people start feeling like they're going to miss out on easy money. And you've just seen that in the crypto market, and you're beginning to see it in the property market, and you'll soon see it in the stock markets again. And it's like, it's an incredible time of wealth building and a transfer of wealth from like people who don't know what they're doing to people that do. And then what happens is we get to this crazy top where everyone thinks they're going to make money forever. And then the rug gets pulled out and the market collapses in a really, really intense way. So averages at the top of cycle are 38% drops in property prices globally for 250 years. That's freaking insane. Big and drops. 50 to 60% declines in stock prices. Now, you've got to remember that like that is the way markets work. They go up, down, sideways, up, right down, and it is sort of like a pattern, you know what I mean?
It doesn't look like a pattern when you're, in it, and no economists are talking about this sort of stuff either. But there is clues, certain things that are occurring, they leave clues. So this cycle, 18.6 years on average over the last 250 years, it's never exactly the same as it was the previous time. It can
be 16 to 24 years, you know what I mean? Like these averages out.
But the average is sort of 14 years of up with a mid-cycle slowdown in between there, averaging somewhere between 6 and 8 years. And then you've got 4 years of down times as well. And this has basically been happening almost like clockwork with differences every single cycle because new policies come into place, new businesses come into play. You've got a globalized market now, so it's completely different to what it was 100 years ago. But it's been turning and it's been occurring for over 250 years in the US, over 350 years in Europe. And from that update that we saw from Phil a few weeks ago, he saw research on this type of cycle from 1200 years ago.
That was crazy.
That was crazy.
Like people were looking at this stuff for a long time now. The cool thing is like when you understand this stuff and, go read The Secret Life of Real Estate and Banking by Phil Anderson. Go read Boom Bust by Fred Harrison and The Power and the Land by Fred Harrison. Go read Big Debt Cycles by Ray Dalio.
Big Debt Crises by Ray.
Big Debt Crisis, sorry. where he looks at 100 years of different events, but they all play in together. And what you've just got to realize is there's good and bad, there's light and dark, there's day and night, there's positive markets and negative markets. And then once you begin to understand it, you can begin to create a strategy for yourself, for your family, that enables you to succeed in good markets and bad. Because 2020 was a really bad market if you sold all of your stocks in March or April for a 40% loss. 2020 was an amazing year if you sold all of your stocks in December and then rebought all of your stocks in April or March or
which is exactly
May, whenever the bottom was.
And that's exactly what Buffett did. He came out publicly saying that he's basically all in cash in late 2019 and came out saying he's all in April. So like these big guys know what's going on here. And I think what's important to understand is what Ben said, you know, there's not one without the other. There's no growth without the declines. You know, these cycles are going to happen whether you like it or not. It is out of our control. It is systemic. It's gonna happen. You can either choose to learn about it and try and incorporate that into your strategy and into the way that you buy assets, or you can, you know, try and beat this beast. I just don't know how you can try and do it. And it definitely helps me sleep at night understanding these cycles. But where are we in the current one?
Yeah, like I think that's really important because that's all that really matters.
Yeah,
like,
where are we?
You're not going to beat the system and you don't really want to be a hostage of the system either. So it's like what you want to be is an educated investor that makes strategic decisions at the right time based on where you want to be in the future. And it's kind of like where we are right now is in a magical time. Like really, it's like the second best time outside of the very, very bottom starting point of a new 14-year up cycle. So we've come through a shitty stock market. Confidence is improving. And the two next things that are coming, according to Phil Anderson, is one, so we've got cheap credit, but we're going to get easy credit. Now, in 2018, Trump rolled back all of the things to protect the American public from the banking system that Obama put in after the GFC to never let a GFC happen again. And the Treasurer in Australia right now is unrolling not just the things from the Banking Commission, but the things that the Australian government put in place in 2010, 11, 12 to protect us from another GFC. So that always happens. They always unwind. They always create the same new instrument that is much riskier and people go into those markets. So money is going to get a shitload easier to borrow.
And when money's easier, it allows the average punters to have access to that easy credit as well. And when the average punter has access to this, they are investing with more emotion than logic. And this is where you get these crazy booms and obviously big busts following that.
It also enables, like, so many people in Australia have not really invested. Like between 2012 and 2015, a lot of people were like, it's too scary, it's too close to a GFC. And then a lot of people sat on the fences in 19 and 20. And a lot of people just couldn't borrow money either. It was like really hard to access finance with APRA stepping in to slow stuff down because of Sydney and Melbourne. So it's like when money gets easier, all of that money comes rushing in. Like there's something like $125 billion of extra household savings in Australia right now, according to CBA. You've got $35 billion taken out from the super funds in early withdrawals last year alone. Like people have money in their offset accounts. People paid back $300 million last year of extra home loans in Australia.
People have been on the sidelines for a very long time, as you're talking about, because it has been so difficult to access credit and it has felt a little bit scary. But now people are like, oh, cool. Like I'm sitting on a really good chunk of savings. I'm ahead 3 months on my mortgage repayments. Money's so cheap at the moment. It's almost hard to say no to, all of these little things.
Drive. And so the second thing that happens next is lavish government spending on infrastructure. And according to CBA's most recent report, they said that almost 2% of Australia's GDP, which is a shit load of money, is going to flow into infrastructure projects in 2021 and 2022. They're also fast-tracking development all over the country, which is creating jobs. So those two things result in low unemployment rates. By the end of 2022, it'll be below 5% again. full employment, inflation is coming as well, and as a result of that, wages will improve. People are making money in stocks, crypto, and property right now, and that creates a wealth effect, and all of that creates overconfidence in a system. Now, because things have been bad for a long time, in a way, outside of Sydney and Melbourne and a few of the regional markets, like most people haven't really made money for a long time. Like if you bought in 2007 or 8, the value of the Australian stock market in 2020 is the same. We haven't even gone past our previous peak in the last cycle. So people haven't made money, but when they start making it again and there's that blood in the water, it creates that Bitcoin style frenzy and it builds and it builds and it builds. And I'm like excited about that, but that also creates like a hell of a bust too.
Yeah, a hell of a bust. One of the other things that comes in at this time of the cycle is, and this is a really interesting indicator as well, is the announcement of the world's tallest buildings.
The world's tallest buildings.
The world's tallest buildings. And, you know, that makes sense as well. Coming back to the access to credit, you know, these developers suffer the same things as your mums and dads, because in the first half of the cycle, it can be a little bit more difficult to secure finance. So, you know, once money becomes a bit cheaper and easier to access, these developers are taking advantage of that as well. And we've had it here in Australia. We've had an announcement of the tallest building in the Southern Hemisphere going into the Gold Coast, which is expected to be completed in 2026, 2027.
Same thing just came out in Melbourne, like one of the tallest buildings in that city is just to be opened up in 2027.
Now, the funny thing is, I just had my auntie up from Sydney over the weekend and we're sitting down. She just had her 60th birthday in the Q1. She got the penthouse of the Q1 apartments in the Gold Coast, and she said it was just so luxe, you know, like resort style pool on the top level in the penthouse, super nice. But she is into property as well a little bit, learning more about it at the moment, getting ready to invest, which is really exciting. But she was looking at the history of this apartment, and this apartment got sold off the plan and settled in 2007 for $8 million. It then sold in 2019, so 11 years later, for $5 million. So there was a $3 million loss on this one apartment over 11 years. At the time, the Q1 was the tallest building in Australia.
And the nicest building by far when it opened up. It was like everyone wanted to be a part of it.
Yeah, so that's a real example of how this impacts. And we just got an update. I think it was Catherine Cashmore or Catherine Stacey?
Catherine Cashmore, yeah.
And she was basically saying with a big red flag, do not buy off the plan units right now that are going to be finished in 2026, 2027, because all of these buildings are coming to the market and you can buy them off the plan right now. And if you don't understand how this cycle works, you can really make some tough decisions there.
Without a doubt, like it's so awesome to understand this information. Like I suppose at first it scared me because I didn't understand it well enough, and now it comforts me like you couldn't believe. Like
so true.
So in 2018, I was like getting Phil Anderson's email updates, and he said to me that, not me, I say me, it's like his subscribers. You can subscribe to his mailing list and get the exact same stuff that I get, but I'm always bugging him about questions. And he sort of said that now would be a good time with the mid-cycle slowdown coming in 2020, March, he said, back in 2018. And he said that now would be a good time to start considering what you're up to and start getting your house in order. Then in 2019, January or February, he said, it's really time now to refinance if that's what you need to do, to get rid of any assets that you don't plan to hold, to start clearing house and creating a savings buffer and making sure you're safe, because 2020 is now a year away.
And making sure you're ready. And this is one thing that Phil talks about as well, because he's all about capitalizing on these mid-cycle slowdowns and the end of cycle busts as well. So he's also saying, you know, get your house in order so that you can buy some stuff.
Now, I went and caught up with him, I think it was in like September or October 2019. And I did an interview with him, and I asked him off camera, like, what's he doing right now? And, you know, and he basically said that he thinks that it's the risk versus the reward is not there anymore, and he was all in cash. So I rang my mum and my dad, and I said, I've just spoke to this guy, you know, who knows like what's going to happen, but
take it or leave it.
He's doing this. And mum pulled all of her money out of her super fund and went into cash, and she avoided the 40% decline and then bought at the bottom, and dad unfortunately didn't, so he went down and up. Now it's obviously back to where it was, but mum's added 200 grand of wealth to her position, and you know, dad's broken even at an age where neither of them can really, you know, afford to do that.
Just hurts a lot more.
So, you know, it was really interesting. What I do now is I understand this game, and so my strategy is literally this clear right now. It is, I've been buying good quality assets with long-term potential for growth and long-term potential for above average cash flow in the markets that have yet to do well. That's a big one. Sunshine Coast and Brisbane are the two that I've been targeting to set up for the second half of this cycle. I don't know anything about stocks, but I've got friends that do and people that do, and I'm going to start having a more active approach to that relatively soon, within this year or so. And so that's all I'm doing. I've got a number of good quality properties that I plan to hold, and I'll hold some stocks long term, and then I'll hold everything that I currently own all the way through the next cycle. Like, I'm not bailing out because there's a potential crash coming, because I've got incredible cash flow, and in 5 years' time, 6 years' time, it'll be producing an income stream for life anyway, and I want that cash flow at that time. But what I will be doing is I'll be getting myself ready now, not just in 6 years' time, but now, to have a little bit more savings, to invest my money a bit wiser, to think about cash flow more importantly, and to not be over leveraging. Like, this is the time when everyone starts going nuts. And, you know, I still think there'll be some great, incredible buying opportunities over the next 3 to 4 years, maybe even longer than that. We just don't know yet. But, you know, I suppose, man, what are you doing? Like, what's your strategy over the next 5 to 6 years, or let's call it 10 years, and I'll explain mine as well, and maybe you guys can like pull some little chunks of gold from that and, you know, add it to whatever you're thinking already as well.
Yeah, so we've done a fair chunk of studying this cycle and learning a little bit more about it, and having strategic conversations how we're going to use it to our advantage as well. And obviously we're at a very different investment, we're on a different sort of path at the moment. You're a fair few years in front of me, so you know, it's good to get that difference. But for me, I'm still in the accumulation phase. So, you know, when Phil told me that 2020 was going to be the mid-cycle recession, I decided to, you know, aggressively purchase properties. I trusted him in the fact that he was saying that it wasn't going to affect property prices, it was just going to affect the stock market. So I went out there and acquired a good portfolio, and I'm about one more purchase away from that. Now, once I've got my next property, that'll be my fourth one. That's all I'm going to sit on. I'm not going to get too greedy. I'm not going to get too aggressive, knowing where we're at in the cycle, knowing that there's potentially only 5, maybe 6 years left in this cycle. I want to make sure that I put myself in a safe position. So from that accumulation phase where I've been aggressively purchasing properties, I move into what we call the consolidation phase of my investment journey. So what I'm going to be doing there is coming back to the properties that I've bought and add value to them by building granny flats in the backyard, knocking down and rebuilding, generating more cash flow, getting some tax depreciation benefits from the portfolio, really setting them up, because just like you, I've got zero intention of ever selling these properties. I want to hand them over to my kids when I pass away. Like, that is my plan. And I know I'm going to take a big hit at the end, but the long-term passive income is the goal for me, and trading the cycle like that isn't the intention. So I'm going to set them up perfectly and then work on consolidating the debt, paying off as much debt as I possibly can over the next 5 to 6 years, so that when this top of the cycle comes, when this big bust comes, when this next crash comes, which Phil's saying it's going to be a pretty sketchy one, in one word, I'm going to be able to lose you know, if it's potentially 40% of the property values, you know, I'm okay to lose that, because I'm going to have a really decent LVR, hopefully get those LVRs to 50% at the very least, if not 60% owned, 40% debt. have a decent passive income from that portfolio, so I don't have to worry about earning money at that point in time, because you never know what can happen in these tough times. Like, you know, Great Depression, what was the unemployment during the Great Depression? Like 20% or something crazy like that, you know?
On higher, but I actually looked into these Great Depression numbers because I'm like, what was it really like? Like, this is, you know, this is the thing about data, right? Like, when I looked into the Great Depression, people with a university degree during the Great Depression only had an unemployment rate of 6.5% or 6.9%.
Which is still super high when you think about it, but it's a lot lower.
It's a lot lower than like the, you know, you see the photos of the Great Depression of people lining up for their food stamps, and it's like, you thought that was the experience for everyone, but it's like, unemployment rate for like under 25-year-olds was over 25%.
It's kind of like when you have a cyclone in North Queensland or a cyclone here on the Sunshine Coast, and they'll show you videos on the news of what's going on. It's like buildings are coming down, trees coming down, anarchy, and then you realise it's like, oh, that was just the worst of the worst of the worst, you know, in that storm. So they're always going to look at sensationalising the situation.
You know, the same career paths always result in the same position at the end of cycle. If you're in hospitality, retail, tourism, or construction, then the cycle is bumpier.
It hurts.
If you're in
service,
you know, certain services like medicine.
But I guess you think about last one, like it shook up the financial industry over in the States big time.
Oh, massively. Like the financial services industry gets pumped every decade.
I guess what I'm trying to do here is plan for the worst, and then I'll hope for the best.
For sure.
So plan for the worst, set myself up in the best possible way for the worst case scenario. But best case scenario is, you know, I still am able to earn a good income. I'm still getting a passive income from my portfolio, so that once the bottom of the cycle comes, so we've had the correction and we can start to see indicators of a recovery, which is, you know, probably a bit too much to go into what those indicators are at this point, but there are certain indicators, looking for those and then aggressively getting back into the market and trading this next cycle, which I'll heavily invest at that point in time in markets like Sydney, in Melbourne. I'm thinking in the next cycle I'm going to take advantage of the United States as well.
That's awesome, bro. Like, it's really brutal to say that, actually, like, because, like, you know, it's other people are affected by this, but what we're trying to do here is get you in front of it. Like, when I found out about this stuff 4 or 5 years ago from Phil, it has got me ahead of the curve.
Yeah.
I see things turning before the media tells you it's positive.
Yeah.
And I see them going negative before other people are saying they're negative. And that's all this is about, like protecting your downside risk and improving your potential upside risk as an investor as well.
And that's what we should be doing as investors all the time.
All the time.
That is what your job is as an investor.
Yeah, so my personal strategy is similar to Simon's. Like, I've got some properties that I'm going to hold forever, and I'm stoked with them. Like, they're just houses with granny flats in good parts of the city or the sunny coast, and that's it. And it's like, my intention now is to slowly pay them off. I may add 1 or 2 more speculative properties that I hold for the next 4 to 5 years and sell for a profit to help pay off some of that debt faster, but I may not. I'm going to start looking at stocks because, you know, I think it's something to look at. I think it's just another business, and my stock strategy will be the same as property. There'll be certain stuff that I buy and hold forever.
Yep.
And there'll be certain stuff that I buy, sell at the top, and then reinvest at the bottom. But I'll be like 40 odd when this next one comes through, and you know, my intention at that time is the same as Simon's: buy your big cities in Australia and around the world for great prices. What we didn't say is that these big cities historically have gone up by about 80% in the first 7 to 8 years after a GFC. So there's such big potential to buy 30-40% cheaper in like Bondi or Noosa, and then sell 100% more expensive within the 10-year period, which is incredible. And then same thing, like really know my stock stuff at that point when it comes on sale at 50 cents in the dollar, and not be afraid to sort of jump in there, grab it, hold on for a few years and safely get out. So like, I'm excited about the good and the bad times.
Cautiously optimistic.
Yeah,
that's what we are. I think cautiously optimistic, and these are ideas. And Phil's been on the money since we started following him, no doubt about it. So starting to build a lot more trust there. But you always got to take everything with a grain of salt.
There's been periods in history where we haven't had a regular cycle. World War One, World War Two. Major wars can sometimes disrupt them. There's been other things in history where they've been brutal. Like brutal in 1890, I think property prices in Australia went down 90% in 3 years after the mining boom was over, the gold rush.
Yep.
There's other times where we've gone through this, like 2007 to 2012 was magic in Australia somehow.
Yeah.
We just completely avoided it.
Yeah, just completely avoided the GFC and didn't see any property declines basically, and
which scares the shit out of me, but it is what it is. Like other resource rich countries like in Europe and Canada did really well too, because at the same time that the world was fucked, the population grew and they needed minerals, and so exporters like us were so lucky to get like iron ore and coal out of the ground at that time, and gas that saved our absolute arse. But we may not be lucky this time around to get out of it just as clean again.
For sure, and that's why you got to set yourself up and understand this information as well. So do with it as you will. I would highly recommend going out and trying to find a copy of The Secret Life of Real Estate and Banking.
It's tricky and expensive to get, but it's bloody worth it.
Yeah, it's definitely worth it. It's just a small investment in having a little bit more clarity, and anything that's going to make me sleep better at night is what I'm in for.
What I love about the book is it talks about indicators like the tall building. It talks about the yield curve, which is a beautiful thing where it looks at short-term and long-term bonds and this inversion point, which generally forecasts a recession. If you look back, it inverted about a year and a half ago, and boom, within 9 months we're in a recession. It's every recession in the last 100 years it's predicted.
Yeah, this isn't just some dude's ideas, it's all backed by certain indicators.
Yeah, you look at stock markets, and when we hit second bottoms of like a long-term low, the trigger points to buy. It's very, very, very data heavy. If I was reading it again, I'd just go straight to the end of the book, read all of the good stuff, and then if you're a history nerd and love the data like I do, you can go learn more. Fred Harrison's work's much easier to interpret. Like Boom Bust is a super simple book that came out in 2005, basically calling the date of the GFC a couple of years later. Incredible stuff. Like, why wouldn't you, if you want to actually invest your money and get financially free, figure this stuff out, you know what I mean? And really figure out how it works for you. And you know how easy the next 5 years is for me and Simon now, because we know what our plan is. And it's not scary hitting a top if you've got a bit of a war chest to get through a couple of really bad years. And
if you're prepared for it as well. Like if you know you're going into battle, you're prepared for battle. But if it just happens out of nowhere, then you're gonna become unstuck. And what's going to happen at the top of this cycle is things are going to feel amazing. People are going to feel like the good times are never going to end. Everyone's going to be earning money. Everybody's going to be investing in assets. Good times are to come. And you don't want to come in at what Phil calls the winner's curse of this cycle, which is the last sort of 3 years to 18 months at the top of the cycle where things just go absolutely apeshit. You ideally do not want to be getting in at those times, because that's where it's all going to come crashing down in the end. And I remember meeting this guy in the United States on my first trip over there. He was an Uber driver at the time, and he used to run.
What year was this?
This was in 2014. So
things were on the mend.
Yeah, things were well and truly on the mend, but things were way worse over there. Yeah. Obviously so much worse over there. But this dude used to be the CEO of a big multinational corporation, and he had his head office in New York City. He had a family, he had, holiday house in the Hamptons, had the really expensive house, running this amazing business, and then had no idea of the cycle. All came crashing down on top of him. He lost his business, he lost all of his houses, his family ended up leaving him. He moved to LA to start a new life and was earning 30-40 grand as an Uber driver, as opposed to the $3-4 million that he was as a big CEO back in the day. So it's just these things hit everyone and you know, bad things can happen in these big downturns. So just make sure that you understand it to the best of your ability so that you can make smarter decisions.
One thing that we didn't talk about, which Phil talks about in his cycle, is the winner's curse phase. Now, an example that people would know in the winner's curse phase was Bitcoin. When was the last big rush? 2018, when it went to like 25.
Now, like a couple of months. I guess
but we haven't got a recall yet. But
yeah, it was kind of when Elon got into Bitcoin and everyone was like, "Oh, now Elon's in, it can't crash."
And that's dangerous as fuck, thinking like Elon's not an investor, but he is as well. It's like it's just being aware that like this winner's curse phase is when everybody jumps on the piggyback and everyone thinks it's never going to like stop. And a good example of this was in 2016, I was talking to people who were still buying in Sydney. Personally, I was getting rid of all my assets down there. I didn't know this stuff properly yet, but I could feel what was coming.
Yeah.
And realistically, people haven't made a gain since 2016 in Sydney, in real terms. It's like people were camping out in Western Sydney and Penrith, and they were selling like 30 lots, and there were 2,000 to 3,000 people camping out for days waiting, racing, signing off on these things, and the pieces of land in some instances were going up 300k in the day.
It's just insane.
Now it's like, you understand that that's like, when that's going on, that's why prices came back by 15% in Sydney.
It's too hectic. It's the old Buffett way, which is be fearful when others are greedy and be greedy when others are fearful.
Fully.
It really comes down to that. Another example is last year, a lot of my friends, a lot of people that I know were getting into the stock market and starting to trade in throughout 2020. And
after the strongest 7-year bull run in history, everyone comes in.
Yeah, because everyone's talking about it. Everyone's making money. Everyone's going, you've got to get into this stock. Like, I've made X amount of percentage over this period of time. And everyone's like, oh, I've got to get in. And they do. And I've sent through some of my close friends some articles from Phil saying, look, this is what this guy's doing. You know, I don't know much about stocks, but you know, he's on the money here. He's been pretty accurate in his previous predictions. You know, maybe you should take this on board. And they're like, oh, no, don't worry about it. I'm just going to throw $10,000 into the market. And then, you know, that 10,000 becomes 6 or 7 really quickly. And it's just like, you know, I know that's not a lot of money, but at the same time, it is, you know, money's money.
Yeah, 30 to 40% decline is devastating. It's, you know, being aware of this, right, I suppose is the most important thing. Like, you know, 2024 seems to be like a point where like Phil reckons the winner's curse will really kick in after that point. You know, that's the point where people are just going to speculate because it'll be, you know, a slow burn and then it'll build momentum. And it's like just being hyper aware that they're the people that get the most damage. Like people that are buying in 2020, 2021, 2023, if they're buying the right asset in the right market at the right price and being sensible, generally fare okay. But it's the people that come in last, aggressively over the top and pay too much. Like reading the history book, there's examples of like stages in Florida and Chicago where people are coming in and paying 100% more a month later for a place than they were worth the month before. And so what happens is you see more people coming into real estate. You see more people coming into financial services. You see more video guys. You see more crypto guys. You see more everything.
Wealth creation people.
Everyone's making easy money because they've come into the cycle at a stage where there's easy money and everyone's an expert and everyone's just not understanding what comes after that. And it's just, I just want to protect everyone from that. Like, you know what I mean? Like that's where this is coming from. It's like, you know, just be aware and take full advantage of it for now and then just peel back, you know,
when the time is right. We're going to do everything in our power to educate you on this cycle, and we'll definitely be having a number of conversations with Phil between now and the top of the cycle. So hopefully, you know, we can relay some of that information to you guys. It is tricky stuff. It is predicting the future in a way. And
we can't do it all.
We can't do that. Phil can't do that. But, you know, there is certain clues that people have been studying for centuries that, you know, make it a little bit easier to maneuver through this time. So yeah, we're just trying to do our best to relay some of the information that's helped us sleep at night, that's helped us set ourselves up really well and take advantage of certain times. And yeah, we just want everyone to do well and not fail, ideally.
Yeah, I mean, and if you do fail, like I've failed a heap, failing's fine, but like learn from it.
Yeah.
You know what I mean? Like the mistakes that I made, I've learned from. Like we're all going to fail. None of us has a crystal ball. This cycle could be dust if it changes. You know what I mean? The more people that know about it, the less of a pattern there'll be, and it'll change into something different. It's like, I just want, yes, like I want to correct you on that, man, to be honest, because investing in real estate and stocks and business is just constantly failing. And there's this perspective in society that I had for 10 years, which is like, you have to be perfect. And it's like, you don't even have to be 50% right. You just have to have a good enough plan that works for you, that you can talk to your financial advisor and accountant about, and a good enough strategy to get you from A to B. Like the plan that we're following is certainly not perfect, but it's fucking epic for both of us.
Yeah,
and it's like,
works.
It's gonna get you through. Like you don't have to hit home runs, guys.
Yeah.
And you don't have to be scared all the time either. You can be in between and create an incredible life with passive income for your family if you have a sensible strategy, and then you go deep. Like I'm 11 years now personally into one thing, and people are always like, why aren't you doing stocks? Like, why aren't you in crypto? Like, and I'm like, why are you doing stocks, crypto, property, business, and your own job? You fucking none of them are working for you at all. Like, get obsessive about one thing and own it.
And
I'm sure in
that.
10 years, if you just do crypto,
You'll be
you'll
on
nail it.
fire. Hell
if you
yeah.
just do a business, if you just do property, it's like choose your lane. And you know, once that lane's working and successful and you've replaced your income, you know that it's going to take 10 years to pick up the next lane. You know what I mean?
It's so funny. Like literally a couple of days ago, as Ben's talking, we're learning about trading the stock market at the moment. But I was listening to a podcast with Warren Buffett, and he's like, you know, it's not about, as you said, hitting the home runs every single time. There is going to be so many opportunities in your lifetime. And he was using the example of Microsoft. You know, he was mates with Bill Gates in the early 90s, and he could have got into Microsoft in the very beginning, but he passed on it because he didn't understand it. And then he had another opportunity to get in with Bezos and Amazon in the early 2010s.
Wow.
And he passed on it because he didn't understand it. And what he was getting at is like, when you're creating your investment strategy, focus on things that you're relatively passionate about. Focus on things that you understand, and understand that you're going to miss out on opportunities. You know, we both missed out on the Bitcoin run. We got told at $4,000 to get into the Bitcoin market. We decided not to because we didn't understand it. People ask me the same questions. I go, look, once I've figured out property 100%, then I'll look at expanding my knowledge into something else, and then I'll look at diversifying. But I think it's so true, you know, just stop doing too much, simplify your strategy, simplify your plan, and really become a specialist or an expert in one area, and then the rest will come.
I love that, man. Like you said that so well. It's so hard to do, and I know it. Like I felt it for so long when I was in my 20s. I'm like trying to just figure it out, and I'm like, now I'm just like, fucking do less. Like, you know what I mean? It's like, let go of the need to control, let go of the need to have all of the right answers now, and just trust that if you get the tiniest bit better each day, and you pick up RP Data's newsletter, you pick up Phil Anderson's newsletter, you read a couple of those books, you pick up SQM's newsletter and HTW's, over a year, you're going to read 200 things that change your life for the better as an investor. Like every single thing that Simon and I like rattle off now is based off third-party information. Like I don't have a clear set way of doing anything in property. I just constantly learn and then maneuver to make it better and better and better. And it's like, oh, that's a really good thing that I've been missing. Immediately added into the buying strategy. And it's like, with that type of mentality towards investing, that it's like the journey, not the destination.
Continuous improvement.
Yeah, it's just, you'll get there. And I don't know, like I feel now, I couldn't know what I know now back then because it's taken 11 years to figure it out. And it's a lot easier. Like a couple of good houses, like our 2 properties to financial freedom strategy, if people are sitting there like going, fuck, it's all well and good for you guys to talk about it, but you've put in your 10,000 hours already. It's like,
where do I start?
Where do we start? Like, where do you start is completely up to you, and there's 1,000 different ways to do it. But if I was starting again in my position and I knew what I knew now, capital cities, close to the city or the beach, I like properties with the potential for more cash flow. So it means more affordable cities, hopefully with 2 incomes rather than 1. I like to get some tax benefits because the Australian government's lucky enough to give them to us at the moment. I like to have a property that I can, put a coat of paint on and make it look better and make some money on. And I like to just buy at the right time of the cycle rather than when everyone else is in there and it's 100% more expensive than it was 10 or 5 years ago. And so it's no more complicated than that. For me, I'm looking at Brisbane for my next purchase. I'm looking at a part where I can do a granny flat. I'm looking at renting them out, and I'm looking at keeping them for the rest of my life and passing them on to my kids. And that is legitimately it. Like it's so freaking easy if like you can let yourself make it easy.
Yeah, you just got to simplify and stop overcomplicating things because, yeah, everyone's got an opinion, right? And that's what makes it...
Us
included, no doubt about it. Like that's
got fucking a lot of opinions.
But... you've really got to spend that time figuring out what you want. And, that in terms of a clear next step, 100%. I would even go as far to say that, yeah, you're still in the camera, bro. Don't worry about it, man.
Sure
you look good. Don't worry, bro. I think starting with the future, and that's where we started. Like, we don't live in the future, but we know where we want to be in the future. And then it makes it a hell of a lot easier to create your plan once you know where it is that you want to be at a certain point in time and what your life is hoping, what you hope your life is going to look like when you get at that point as well. So we've done heaps of videos on the Australian property market, on how to identify the right market, how to identify the right suburb, how to identify the right property. We've done different strategies. There is lots of information out there, and I'd highly recommend going back and listening to some of those podcasts. If you are just at the very beginning, this is a lot deeper level stuff, but is still just as important. But take your time and learn that and understand that you don't need to have it all right now. You don't need to have every single piece of the puzzle put together straight away. You might not be able to see the forest through the trees in the very beginning, but start with learning, start with reaching out to the right people, and hopefully that plan slowly but surely comes together.
I'm just so grateful that we get to talk about this stuff.
Yeah, dude.
I'm so grateful that I was so anxious at that point in my life, and I dug all the way down to find this stuff that I just can't believe everyone's not talking about. And I'm so grateful we get to share it with people, and hopefully you guys benefit off the back of this. So good market, bad market, we just want the best for you, and we wish you all the best. And, we want you to invest safely and go get the right advice from the people that can give it to you out there. And, we wish you all the best in the coming years. And, if this works out, cool. And if it doesn't work out in terms of the timing and stuff like that, we just slightly adjust, and we'll bring you that information from the likes of Phil and the Fred Harrisons as they bring it to us as well.
Yeah, thanks so much, bro. I really appreciate it. And please share this video with somebody that needs to listen to it at the moment. Give us a like, give us a 5-star review. We would absolutely love it. The more reviews that we have, the more people get to see this thing. So thanks so much for tuning in. Thanks for sticking with us this long, guys. And as always, invest safely.
Sweaty, so sweaty.